With the conclusion at the Fed meeting last week to hold steady those rates, we can see it is unchanged at 5.25 to 5.5%, continuing the downfall of REITs, as we can see year to date down double digits for the vast majority of them. Therefore, in today's episode, we are looking at 4 strong undervalued REITs near their 52-week lows to buy, as well as 1 REIT to sell. We're going to look at each of them individually, looking at their historical performance, their dividend safety, their underlying financial metrics, the free cash flows, the ROICs, etc. And we're also going to run them through the valuation model, getting to both our intrinsic value as well as our acceptable buy price, given our investor margin of safety, as well as looking towards Wall Street for their forecasted price over the next 12 months. Now, towards the end of the episode, we are also going to take a look at an ETF for REITs for those that prefer to have maximum security rather than investing in individual REITs themselves. We're going to take a look at the Schwab US REIT ETF. We're going to go through the performance, the portfolio, as well as any other bits just to be aware of. So let's jump into the first undervalued strong REIT to consider in the portfolio. Now, each one of these has some very large upside that we will cover. We can already note 2 buy ratings from Seeking Alpha and Wall Street, with 1 hold rating from Quant. As we can see, it is trading right there towards their 52-week low. In terms of the dividend on a forward-looking basis, 2.43%, and they P to FFO forward of 27.83%. Now, over the last year, it is pretty much flat, 0.37%. However, over the last 10 years, we can see it is up over 297%. Bear in mind, if you reinvest those dividends, it would be slightly higher. Now, in terms of their dividend safety, a very safe score at 86. Market cap 66.5 billion. It is a large cap company. Now, in terms of their dividend safety, we can see it was just reaffirmed not too long ago, so a dividend cut does look to be highly unlikely. Now, in the last recession, they didn't pay a dividend, so no comparative data, but they had plus 25% recession sales, well above the average of the S&P, sitting around negative 12, but we do note they had a near S&P return, negative 56, when the S&P came in at a negative 55. Lots to like about dividend growth just last October, 25%. Over the last 5 years on average, nice double digits at the 10% level. Now, we do also note they have been increasing those dividends for the last 8 years consecutively. As always, dividend yield theory is something we look at, and for new investors, it essentially states a company is undervalued when the current yield sits above the 5-year average. So we note our first signal of undervaluation, in fact, another signal with the forward P to AFFO below the 5-year rolling of 24.4. Bear in mind, though, we don't look at any of these models in isolation and will conclude towards the end. We also note, however, it is slightly higher than real estate sector at 13.7. What's very important with these REITs is to look at the safety of those dividends. Now, normal companies, we do look at the free cash flow. However, for REITs, a lot more volatile. So we draw your attention to the adjusted FFO, funds from operation payout. Below 90% is the target for the majority of REITs, and no worries whatsoever. In fact, below 50% every single year. FY24 expected to be around 49%. In terms of the adjusted funds from operation per share, what we want to see from this is essentially consistent increases year on year, and it's very nice to note, in fact, more than doubled over the last 10 years. FY24 expected to increase again. So this is a very strong, essentially consistent company. And we know very consistent as well, because when we look at it on a percentage basis, just the last 4 years, 9% growth to the AFFO. 2024 again expected to be 9% too. Now, with sales growth, with REITs, we want to see moderate growth, 5 to 10%, and we see over the longer term for EQIX, very strong performance, 15% just in the last year, and numerically speaking, we can see here it has essentially tripled its top line over the last 10 years. Now, this doesn't look that great. In fact, increasing shares outstanding does dilute your position as a shareholder, but do understand that for REITs, this is very typical. Main reason for this is they don't retain a lot of that internally generated cash flow, as they do pay the majority out in dividends. but I would say this isn't essentially increasing at a very fast rate. Not that bad at all, especially when you look at the likes of other REITs in the industry. ROIC giving us faith that management are able to effectively allocate their capital. We want to see 3 to 5% for REITs. We do know that it has started to decrease over the longer term. 3% is really the minimum we want to see, which we have in 2023, but something to keep an eye on so we don't see it fall back to those 2022 levels, but incorporate it into your investment thesis as well as your margin of safety. Operating margin, not the greatest in the respect of that it has been decreasing, so operational inefficiency, ideally around 16% as a minimum. So over the last few years, it has straddled around that line. Definitely something we will incorporate later on. When we look at the net debt to EBITDA, now this is very important. The reason why is because it correlates to the balance sheet strength as well as dividend safety. EBITDA, earnings before interest, tax, depreciation, amortization, below 5.5 for the majority of REITs, and we can see these numbers are effectively the number of years it would take the company to pay off all of that debt, net of cash on hand. Looking very healthy, 3.83 in 2023, 3.46 in 2024, so very strong balance sheet, and that dividend, as we saw earlier, does look to be very safe. Now let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now typically on the channel, we do run through every single one of these models. Today's episode, let's jump straight into the intrinsic value, which for today is arriving at $902. Now current price sits around $717, and margin of safety, very important, and we use 10% and only execute if it meets the 3 golden criteria. So it has to have a wide moat, strong financial metrics, and good forward-looking data. If you believe that, then it's a buy up to $812, and then we keep going till it's near the current trading price. And we can see in today's episode, it does have a 20% MOS level, and this does look like a very strong REIT in my opinion. We did run through the metrics, 1 or 2 to keep an eye on, but overall I would say this is in the high quality bracket. In terms of Wall Street, well, they have upside of 28% over the next 12 months, and they see a price target of $919, slightly higher than our intrinsic value. As always though, let us know your thoughts as we do go along these REITs today. We also just want to let you know we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on the pinned comment below and you can get instant access. We just want to draw your attention to this one here. This one, essentially, we run through all the websites that we use in our analysis. It is highly requested, so something just to place emphasis on so you can take a look. Moving on to the next strong undervalued REIT, we have Rexford Industrial Realty, one we have looked at before. We have 2 buy ratings, Wall Street and Seeking Alpha, with a hold rating from Quant. We also note right there towards their 52-week low, and the yield trading 12 months at 3.51%. P to FFO forward looking 18.8. Now over the last year, it has been hammered like the majority of REITs, down 19%. Over the last 10 years, however, a strong performance, up over 207%. And we see all-time highs sitting around the beginning of 2022 at $81, nearly double the current trading price. Dividend safety, another very safe score. Market cap just shy of 10 billion. It is a mid-cap company. And again, we can see just 2 days ago, it was reaffirmed that the dividend score is very safe. Key metrics, well, as we can see, this wasn't listed in 0709, hence why we have no comparative data. But when we take a look, very strong dividend growth, one of the best in the REIT industry. It definitely goes under the radar. Just under 10% this year, 19% on average over the last 5, 22% on average over the last 10 years. And we can see they have been increasing those dividends for the last 10 years. So let's take a look at dividend yield theory. Again, no surprises, a double undervaluation signal, 3.76, the highest it has offered over the last 5 years with the average of 1.91. Forward P to FO very low at 22.5 compared to the 39.3 we have seen over the 5-year period. But we do also note the real estate sector does sit much lower at 13.7. Now, how about looking at the payout ratio? Again, below 90% as essentially a blanket rule. It has been near that in 2023. Nice to note it is expected to come down, so no real glaring issues so far. When we move on to the adjusted FFO, again, a little bit of inconsistency. However, towards the back end of the data, we can see from 2015 nice consistent increases. That is expected to continue in 2024. And when we look at this on a percentage format, again, you really want to be investing in REITs that increase the adjusted funds from operation per share at a very strong rate, like we have seen in the previous REIT as well as REXR. Sales growth, even though it does look like it is decreasing, still significantly higher than the 5 to 10% that we want to see as a minimum baseline. And numerically speaking, we have seen some very strong growth over the last 10 years. However, with that growth, we also note the shares outstanding has increased quite rapidly, but bear in mind the AFFO per share is very key to look at, and that has been increasing at a very strong rate. When we take a look at the ROIC, now you know we want 3 to 5%, so not that great that over the last 10 years on average it sits around 2. What is key? 2023 at 3%. Hopefully we start to see this continue to increase as we see the trend over the period. Operating margin, very good. With the previous REIT, we did see operational inefficiency. With Rexford, we note the opposite, operational efficiency, increasing their top line, their AFFO, as well as the operating margin. Very positive to see when we investigate real estate investment trusts. Net debt to EBITDA. Now, what is interesting to note, it was very high at the beginning, 2014, 2015. It has started to come down in a decreasing trend to 4.06 in 2023. However, we do note a small increase expected next year. Still below the 5.5. Therefore, with this and the payout ratio, the dividend does look to be safe based on this data today. So let's jump into the valuation. Always important with strong REITs, if we do like them, to make sure we are buying them or considering them at a very good value with a decent MOS level. Intrinsic value just under $59, current price around $44, so 10% MOS level at $53. It is a buy if you believe it meets those three criteria. At 15%, $50, at 20%, $47, and at 25% we can see not too far off. So today's episode, Rexford Industrial, 25% margin of safety, and Wall Street give it a 31% upside, a price target of $58.20 over the next 12 months, making this one a serious consideration for your REIT portfolio. We then move on to GLPI, and we have a notable triple buy rating from Seeking Alpha, Wall Street, and Quant. Again, another one that trades right there towards their 52-week low. Yield very high for those that love those high yields, 7.04%. P to FFO looking decent, 11.47, but similar to the industry, down 14% over the last 12 months. Over the last 10 years, marginally up 24%, something that ideally we want to see in the triple digits, so something just to consider. When we take a look at the dividend safety, 41 borderline safe, so we can dig deeper. Market cap, 12 billion, a large cap company. Now, we do see it was reaffirmed just too long ago, so it does say a moderate risk of a dividend cut, so we should emphasize that this is something that we will need to consider, not just in our margin of safety, but our overall, essentially, investment thesis. Dividend growth, 4.1% just a few months ago. Nice to note the yield, or the starting yield, in fact, is quite nice at 7%, whilst also increasing it in line with inflation, although over the last 5 years, we do note only a 2% increase year on year, and we can see they have been increasing those dividends for the last 3 years. Dividend yield theory then, we can note a double undervaluation signal, both yield as well as forward P to FFO, looking like it does being a consideration for the portfolio. Real estate sector in this case is slightly higher at 13.7. So let's look at the essential AFFO payout ratio, and what we notice over a longer term, it was in fact a red flag indicator, or what I would consider to be in the triple digits. Nice to note it has come down and fairly consistent over the last 4 years, 81% expected in 2024. So again, looks like it is safe based on this data, but we continue to go through. Remember, AFFO, we want it increasing consistently year on year, so there is some inconsistency to be noted. However, over the longer term, it has doubled. 2024, we are expecting an increase as well. And when we look at it on a percentage format, we can see low single-digit increases over the more recent period. Sales growth, we note 5 to 10%. It has been hit over the last 3 years. 2020 with that COVID year at 0%, but even before then, it was looking like growth was a very strong point of this company. In terms of total sales, well, we can see it has nearly tripled over the last 10 years. Shares outstanding, again, very, very common in REIT industries. Always good to look at other competitors just to see whether or not this is typical. But with this industry as a whole on a general overview level, it is something we always see. ROIC, very strong, one of the best in the REIT industries, looking very good, nearly like those other companies where we want to see a minimum of 10%, but with REITs at that 5% upper level, it is very strong, as we can see 9 to 8% just over the last 6 to 7 years. How about the margins? Well, operating margin, operating efficiency, we love to see this, very high margins, even just over the last 2 years, 74% is something that is very attractive to investors as well as those who are looking to be investors in the company. Net debt to EBITDA, again, we want to see this below 5.5. We do note it has a borderline safe dividend score. Given the fact that the FFO payout ratio is towards the upper end, we would ideally like to see this come down lower. 4.69 expected in 2024. So for right now, the dividend does look to be safe, but these are some of the metrics we do need to consider quarter on quarter and maybe in those latest annual reports. How about the valuation then? What is that intrinsic value of GLPI in today's episode? And it arrives at $53. So just remember, you can grab a copy of the valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those in your watch list by clicking on the pinned comment below. 10% margin of safety up to 47.89, 15% 45, and at 20% it isn't quite there yet, but really not far off. We're talking around 40 cents. So in today's episode, GLPI a 20% margin of safety. In terms of Wall Street, well, they see significant upside. They see 51% over the next 12 months, $64.86 as a price target, much higher than our intrinsic value. So they see this as an absolute no-brainer. But as always, let us know your thoughts, especially if this is one that you have been keeping an eye on over the shorter period. We then move on to the next undervalued REIT, which is SBA Communications. We have two very high buy ratings, 4.4 from Wall Street out of 5, but we do also note a strong sell from Quant. We can see right there towards their 52-week low, a yield just over 2% and a P to FFO of just over 15. Over the last year, like others in the space in the telecoms, down 20%. Over the last 10 years, however, up 100%. And we can see their all-time highs sitting around that $375 mark. In terms of dividend safety, well, a 60 score, borderline safe, market cap 21 billion, a large cap company, and again reaffirmed very recently a borderline score. In terms of their key metrics, well, in the last recession they had plus 11% sales, significantly above the negative 12 that the majority in the S&P had. Dividend growth, well, we love to see this, 15% just in February 2024, lots to like, and we can see 4 years of increasing those dividends. So let's look at dividend yield theory, a very high undervaluation signal, 2.03 versus 0.79. Forward P to FFO, again a very similar story, strong undervaluation and marginally higher than the real estate sector at 13.7. So what about the adjusted funds from operation payout? Well, very low. So I do love to see this. Only 29% expected in 2024. So that does give me faith that the dividend does look very healthy, but we still need to consider the other metrics. Again, lots to like, consistent increases long-term on the AFFO, again expected to continue into 2024. And when we look at it on a percentage format, this is something that is really nice to see as shareholders, although we do want to point out next year it is expected to drop to the low single digit. In terms of sales growth, a little bit mixed, yes, 5 to 10%, but 2023, 3%, 2023, 3%, and the last trailing 12 months, 0%, so just something to factor in when you are doing your own research. Very, very interesting to know. One of the few REITs where actually they do the opposite. They do share buybacks. So that is a very good thing to note for this company. Effectively returning excess cash to investor pockets as you get more control and ownership over the REIT. In terms of sales, well, we can see nearly double over the longer term. And when we look at the ROIC, incredible. It has been increasing and very strong. 10% in 2022, 11% in 2023, trailing 12-month 13%. So lots to like here. Operating margin, operational efficiency, very strong. Always good when companies increase their top line as well as their operating margin as well as their adjusted funds from operation per share. And in terms of net debt to EBITDA, so now we see the main culprit as the reason why that dividend does have that borderline safe score. Their debt levels are very high. The only thing we would say from 2019, it has started to come down, but even so in 2024 at 6.25, it is still above that below 5.5 target that we want to see. Something to factor in, but now let's importantly move on to the valuation. So as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So $226.38 as that essential intrinsic value. Margin of safety of 10%, a buy up to 203. At 15%, pretty much around the current trading price, just around 50 cents shy. So it does look like it has something that some people would consider to be good enough to start a position. But as always, let me know your thoughts. In terms of Wall Street, well, they see this again, very strong 34% upside, $259 target over the next year. So it is something that they do believe should be a large consideration in your REIT portfolio. We then move on to the one REIT to consider to sell, and that is Healthcare Realty Trust Incorporated. We do know one buy rating from Seeking Alpha, one hold rating from Wall Street, and one sell rating from Quant. Again, this similarly is towards their 52-week low. It does have a trailing 12-month yield of 8.33% and a P to FFO of just under 10. Over the last year, hammered down negative 25%. And when we look at it over the last 10 years, the first one we have looked at today with even over the last 10 years, a negative 28% return. Obviously, if you were to factor in dividends, it would be slightly higher, but it does go to show historically this has been a very poor investment. So let's take a look at the dividend safety. No surprises there. A 40 score unsafe market cap, just under 6 billion, a mid-cap company. And we can see again, this was in fact downgraded in March to 40, so now it does look to be unsafe. How about the essential key metrics? Well, last recession, whilst no dividend was paid, they had negative 7% sales, which was slightly higher than the negative 12 of the S&P. Dividend growth, very poor, 0% since August 22, 1% on average over the last 5 years, negative 3% over the last 20 years, not a great investment, and we do know they only have 1 year of consecutive increases. Dividend yield theory, we can see, appears speculative, so that is something that you just need to consider. The stock's historically high yield may not be a good indicator of value, and as we can see here, conservative investors may prefer looking elsewhere for income. When we take a look at dividend yield theory, we would essentially see an undervaluation signal on both of these metrics, so let's consider and understand why we have that appear speculative mention. Not too far off the real estate sector at 13.7. And when we get into essentially the payout, we have the first reason why their essential medical building REIT 95% target has been smashed through in 2023. 108%, 110% expected next year. So a massive red flag indicator straight away to show that they are paying out essentially more than they earn in adjusted funds from operation as dividends. So we do understand, and we can continue to see if there are any other indicators. Adjusted funds from operation, it has been decreasing over the longer term and very inconsistent, expected to decrease into 2024. When we look at it on a percentage format, there is a very good indicator there. We have essentially 7 of the last 10 years, or in fact 6 of the last 10 years where we note negative growth rather than positive. Again, expected that into 2024. Although we do note their sales has increased quite dramatically just over the last 2 years. Numerically speaking, it has in fact increased quite significantly, although we see the jump from 2021 to 2023. We also note they would have diluted your position very rapidly over the same period from 21 to 23. In fact, we note it has more than doubled over that period. That is also a red flag indicator. ROIC, again, remember what I said, 3 to 5% as a real baseline minimum. In fact, not only has it been decreasing, but 0% in 2023. That is not a good sign of any company or any REIT. Operating margin, the signs just keep getting worse and worse. Operational inefficiency decreasing down to 4% in 2023. There isn't really much else to say. That is not a good sign. And when we take a look, we extend this to below 6 as opposed to 5 or 5.5 for medical building REITs, and we note it is still above that in both 2023 and expected in 2024. So lots of red flag indicators. Now we will do the valuation, even though we do believe this is one that we would not include in any REIT portfolio, and we get an intrinsic value of around $17. Now we do the usual 10% margin of safety, and we can see it would be right now trading at around a 10 to 15% MOS level. You could argue nearer to the 15%. And in terms of Wall Street, their indications is upside of 14% with a price target of $17. Now you may look at this and say 15% MOS level, 14% upside. Why isn't this a company we should look to invest in? But just take a look at the metrics from the first 4 REITs that we did. Compare them to HR, and then you'll understand a lot of negative trends, downward trends over the longer term. For me, this is definitely one to avoid or not have in the portfolio. But as always, keen to hear your thoughts below. Now, as we mentioned at the beginning of the episode, there are people who do not want to essentially pick individual REITs. As we just saw, you may get unlucky in some of your investigation, pick a very poor REIT that underperforms over a long period. So you may want to take a look at a investing REIT, which is essentially Schwab US REIT ETF. It has an expense ratio of 0.07%, so it may be on the bit of a pricier side, depending on what sort of target you look for. But as we can see, the whole point of this is to track as closely as possible the total return of an index for the US real estate investment trusts. Now, when we take a look at their performance, and this is one of the reasons why people may actually prefer to look at individual stocks, over the longer term, we don't see that much of a great performance. Over the last year, however, just under 8%. Over the last 5 years, around 1%. And over the last 10 years, 5% in inception, plus 6.46%. Now, again, it will be different investors with different goals, but it is always good to take a look at other REITs and essentially ETFs. We have previously looked at VNQ, which is the Vanguard equivalent, but we wanted to take a look at a different one today. Doesn't mean you should take a look and buy it, but we just want to make clear these are different options for different investors. And if you wanted to see what are the top holdings of this REIT, we have Prologis 8.06%, as well as American Tower REIT at 7%, making up 15% of this total portion. Now, one REIT that we did take a look at, we can see around 4%, Equinix. Now, again, if you'd rather have some exposure to this but not buy it individually, a REIT like this, you will hold around 4.11%. As always, though, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, drop your comments below and we'll see you all on the next one.